Do you aim to own a rental property in the next couple of years, in the next 5 years? In this video, I want to share how I calculate my return on investment. So that goes from estimating costs to obviously calculating the final figure, which allows me to search through Rightmove, search through Zoopla, and go through the actual houses that are on there and figure out what is going to be best in terms of achieving my goals. There's a lot of barriers in life that get in the way, whether that be knowledge, whether that be time. And my aim for this channel is to break down those barriers in order to allow you to achieve what potentially you've always wanted to achieve and reach those goals. In terms of me, my name's Remy, I'm 28 years old, I work in the property industry, I've got one buy to let with the plans to buy another as well, so I'll be sharing that on the channel in the future. What is return on investment? Return on investment is simply a percentage based off of how much money you've put into a deal, how much money it's returning you on a yearly basis after your costs, after your expenses have come out. There are other ways that investors do calculate returns on investments, such as rental yield, which I think is the actual rental income divided by the property value. And personally, although it does allow you to compare different properties in terms of what they're going to return you, personally, I'm a fan of return on investment because it tells me exactly how much my money's working for me compared to if you were to put it, say, in other investments. This being important because you want to be able to go through Rightmove as an example, look at different properties and roughly calculate what you expect the returns to be. From there, what I do is I compile a list of all the different properties that I'm looking at, obviously what return on investments they can achieve me, and then that'll allow me to establish exactly what properties are going to meet my goals. So the way this is calculated is firstly by looking at the net return over the year. So after your costs, after your expenses, what is going to be your profit essentially. And then what you do is you divide that by the amount of money that you've actually put into it, which obviously comes out with a percentage. So as an example, so if an investment was returning you, let's say £100 over the course of a year, very simple example, you put £1,000 into that investment, that's a 10% return on your money. Later on in the video, I'll share what can be considered as a good return on investment, but obviously this will all be dependent on area that you're investing in. So the first key component of your return on investment is obviously estimating what your costs are going to be, your ongoing costs. So first thing to consider is, are you going to rent out the property yourself or are you going to have a managing agent look after it? So as an example, if you were looking at a £700 a month rental income from a property, rented out at 12% by a managing agent, you might be looking at about a charge of about £84 a month. If you were looking at £1,500 a month in rent with a 14%, let's say, charge associated with it, it's about £210 a month that the letting agent would charge you. So next ongoing cost being insurance. So obviously you can go for a basic buildings policy, or if you want a bit more peace of mind, you can obviously look at landlord insurances that cover you for if tenants don't pay rent, if you do want that extra peace of mind. These are obviously something that you can look up on Compare the Market to give you an estimate of what the costs are going to roughly be. Same thing in terms of mortgages. So I tend to use Compare the Market just to give me an idea of what monthly payments it's going to look like. But obviously in terms of actually setting up the mortgage, I did use a broker. And then final fee you might want to consider as well is when you're renting out a property, you're likely to need to do a self-assessment on your taxes. This might cost you, let's say, about $250 to $350 depending on the accountants you use per year. So obviously that might break down to £20–30 a month as an example. So the next key component is the bottom half of that equation. So how much money is actually going to go into this? So obviously there's a lot of different strategies out there for investing in property, but I am just going to look at the most basic: buying a property, renting it out. So typically this would be based on a 20 to 25% deposit. So that's the kind of deposit that you might be looking at in terms of a mortgage. So obviously if you were, let's say, looking at the north of England, £100,000 property, it'd be a £25,000 deposit that was going into it. Obviously there's stamp duty. And what I'll do is I'll link in the description a stamp duty calculator, which will obviously allow you to calculate how much stamp duty you're liable for. This would vary based on your circumstances. In terms of if you currently own a residential property, it will help you, but it's not to say that if you don't own a residential property first, you can't do it. It just means there aren't as many lenders that are able to obviously look after you if that was the case where you don't own a residential property first. Other costs involved, let's say associated with a mortgage, obviously you'll have broker fees. So your mortgage broker will obviously charge you a fee to set things up. This can vary, anything from £300 up to £1,000 for some mortgage brokers. In terms of the mortgage, there'll be some products will have a valuation fee. Some will have product fees to actually set up the mortgage. You might want to sort out a valuation for the property to give you that added peace of mind as well. Legal fees. So for my last rental property, this was about £1,200, but this will obviously vary based on your area, based on your circumstances. And final obvious one being refurbishment costs. So it's not even necessarily refurbishment. You might be able to buy the perfect property, but there is a lot of stuff that you need to sort out. So some areas such as Liverpool, Birmingham, they need to have licenses which you need to pay for to obviously rent out the property. Checking your smoke detectors, carbon monoxide detectors, any costs associated with that. Gas safety certificates. There's a lot of different costs that do come into it which you might not necessarily factor in. So it is all about setting a certain budget aside in terms of what you'd be looking to spend. What this allows you to do as well is, if you're quite fortunate to have a lump sum of money where you potentially could just buy a property without a mortgage at all, but you can compare your returns on investment if you did have a mortgage compared to if you didn't. Likelihood is that your return on investment is going to be that little bit higher with having a mortgage, because this will be you leveraging your money and you could use that towards potentially investing in more properties. Just a couple of considerations if you did want to be a little bit more particular as well, because I know I like to be. I'm a very pessimistic investor. But first one being capital appreciation. So return on investment does not factor in the property going up in value over time. So that's always one thing to consider. You also want to think about when you buy the property, it's not necessarily going to be rented out straight away for 12 months. So now, as an example with mine, there was 1 month before obviously it was rented out. Firstly, me getting it up to code, let's say, and then obviously finding a tenant and for them to move in. So that means my returns on investments, initially I did calculate them, rather than how much money it was going to return me over 12 months, I did over 11 months. But then you also want to be pessimistic in that all of the profit isn't going to be yours. Obviously, you're going to have to pay 20% tax. So again, that's also something that I factored into my calculations. So now, what is considered a good return on investment? This will vary from person to person. I know what I did was I looked at my circumstances, how much money the rental property could bring in, how much money I'm making in my full-time job, and how much I can realistically set aside towards my next rental property. And I came out that I needed a minimum of about 7 to 8% return on investment to hit my goals. I'd say anything around that sort of level would be considered a good return on investment. Key thing being is, obviously, in terms of what banks are offering, they're offering interest rates of, let's say, 4 to 5% if you invested your money there as an alternative. Anything below that, that might not be the best sort of use of your money that's out there, but obviously none of this is financial advice. Another factor to consider is there are a couple of different types of mortgages you can get. So interest only, which works out cheaper in terms of monthly payments, but the mortgage balance stays the same with every payment you make. Capital repayment, where every single mortgage payment you make actually pays down the mortgage you owe, the actual mortgage principal, the capital that you owe on it. So obviously, someone who has a capital repayment mortgage, their monthly payment is going to be higher, their return on investment is going to be lower, but you can argue in the long run, this is going to be a lot more beneficial for them. So it is very circumstantial. But personally, I aim for 7 to 8%, but obviously I do aim for as high as possible. And when I'm searching for my properties online, I'll obviously aim for the highest figures that I can realistically achieve in terms of the properties that I see. So there you have it. You've got your ongoing costs, you've got your initial costs, so you can calculate your return on investment and ultimately decide which property is going to work out best for you. Please be sure to like, subscribe to the video. Any questions, comments, experiences, please feel free to leave them in the comments box below. But thank you so much for watching. I really do appreciate it. I'll leave a couple of links in the description box as well to help you calculate those experiences. But in the meantime, if you check out my other videos, I'm sure they'll help you in terms of breaking down some of those other barriers in your property investment journey. Thanks so much, and bye-bye.